The silver market didn't just move this week, it split in half. In the last 2 trading days of December 2025, Shanghai priced physical silver like a scarce industrial fuel, while New York priced paper silver like it was sitting in unlimited supply. The gap wasn't pennies, it was almost $13 an ounce, and that is the kind of crack that turns into a fracture overnight. Here's the fact. On December 29th and 30, the East and the West stopped agreeing on what silver is worth. And here's the uncomfortable implication. One side is trading metal, the other side is trading promises. We're not starting with theories. We're starting with what printed on the screen. Shanghai closed its benchmark silver at about CNY 18,197 per kilogram on the exchange everyone watches for physical flow. Run the conversion through the rough math traders use. Currency rate around 7 to the dollar, 32. 15 troy ounces in a kilo, and you land near $83, 5 per ounce. At the same moment, New York's futures market sat around the low 70s, 2 prices, 1 metal. That's not volatility. That's a fork in the road. Now, in a normal world, that spread gets bullied back into line. Arbitrage traders smell free money, buy the cheap market, sell the expensive market, and the gap collapses. So why didn't it collapse? Because the trade that's supposed to close the gap is getting strangled by reality. The pipes are clogging. The freight is slow. The paperwork is tightening. And the closer we get to January 1st, the more this starts looking less like a temporary dislocation and more like the birth of 2 separate silver universes. Let's pause on the number for a second. An $83 Shanghai price against a roughly $70 New York price is an 18% premium, 18%. If this was soybeans or copper or anything with smooth global logistics, that premium would be a gift wrapped in neon lights. Buy here, sell there, repeat until the gift disappears. But silver isn't moving like a normal commodity anymore. And we need to talk about why, because the reason changes everything about how we think about spot price. They want you staring at one price chart. They want you hypnotized by the headline, silver down, silver weak, silver range bound. Meanwhile, the physical heartbeat of the world is beating at a different tempo. Now watch this. The mainstream crowd has been trained to treat one thing as the ultimate scoreboard. COMEX vault inventories. You've heard the mythology 1,000 times. The vault is empty. Registered is going to 0. Default is tomorrow. But the latest warehouse reports show registered inventory sitting around 127, 62 million ounces. That is a big number, bigger than it was a year ago, and that's where people get trapped. Because volume is not the problem, structure is the problem. Registered is the silver tagged with a warrant. Metal, the exchange says, is ready to meet delivery obligations. Eligible is the metal that meets specs, sits in the same buildings, but isn't pledged for delivery. Here's the fact. Registered went up. Here's the interpretation. That can happen without a single new ounce being mined. The system can restock the front display by pulling cans from the back pantry. The shelves look full. The warehouse can still be bleeding. And here's the part most people miss. Eligible metal is often not the bank's metal. It's private metal parked in a high-security garage, funds, family offices, big holders who like the vault's security and the vault's insurance, so when registered rises, it doesn't automatically mean fresh supply entered the system. It can mean the banks begged, paid, or incentivized owners to slap a warrant on their bars so the exchange looks healthy. That's not a conspiracy theory. That's how a stressed market survives. It changes labels. If we're wrong, where will it show first? Not in the headline number they want you watching. It shows in the spread, it shows in the urgency, it shows in the curve. Because when real buyers need real metal, the price of later can fall below the price of now. And that is exactly the kind of inversion we're seeing. Front-month contracts have been trading above the next month. December priced higher than January. That is backwardation. For a non-perishable metal, backwardation is a flare gun. It's the market saying, give me silver today, I'll pay you extra not to make me wait. Storage doesn't usually work like that. Insurance doesn't usually work like that. Healthy silver markets don't usually work like that. So we have a contradiction. COMEX is telling the world, plenty of deliverable metal. The curve is whispering, not so fast. And Shanghai is screaming, we'll pay up, send it. Now ask yourself, if everything is fine, why is the physical market in the East refusing to follow the paper market in the West? This is where the story gets sharp, because a new constraint hits like a guillotine at midnight. Starting January 1st, 2026, China is set to tighten control over silver exports. Licenses, restrictions, gatekeeping, call it bureaucracy if you want. Functionally, it's a barrier, and barriers change pricing. If metal can enter a region but struggles to leave, that region becomes a gravity well, a black hole for supply. Bars drift in and they don't drift back out. That's the silver curtain everyone jokes about, until it isn't a joke. Now, let's be careful with our certainty. Fact, policies change the friction of trade. Likely, higher friction widens spreads. Possible, sustained spreads force repricing in the cheaper market. We don't need to predict the future to see the setup. We just need to understand incentives. If Shanghai is paying $83 and New York is offering $70, the global trader wants to buy New York bars and sell Shanghai demand. But to do that, you need more than a spreadsheet. You need physical availability, you need delivery timing, you need transport, you need customs clearance, you need an import channel, and you need to trust that when you arrive, the market still pays the premium. That entire chain used to be smooth enough that a big spread couldn't last. Now the chain is breaking, lead times are stretching, premiums are rising, and regulations are hardening right when the calendar flips. This is why the spread didn't instantly vanish. The arbitrage isn't just a math problem anymore, it's a logistics war. And the friction isn't abstract. It's cash, time, and risk. To do the easy trade, you have to finance metal while it's in transit. You have to insure it. You have to accept that delivery dates can slip. You have to accept that the premium you're chasing can vanish the moment a regulator changes a form. And if you're moving size, you also have to find bars that match the right brand lists, the right weights, the right assay stamps. One wrong detail, and you're stuck with expensive metal you can't tender where you planned. So the spread becomes a tax on trust. And when trust gets taxed, only the most desperate buyers pay it. That's why this gap matters more than a headline price. That desperation is how quiet shortages become loud shortages overnight for everyone. Let's talk about what is pulling in the East, because this isn't driven by internet memes. China is the center of the solar manufacturing machine. Solar paste needs silver, not as decoration, as an input. And this demand is inelastic. If you're running a factory, you don't care what a Western chart says. You care whether your assembly line stops. You care whether a shipment arrives. You care whether you can secure atoms. So the buyer in Shanghai isn't thinking like a trader. They're thinking like a production manager with deadlines. That's why they'll pay a premium. That's why they hold the floor. And that's why the Western price can look cheap and still be impossible to exploit. Here's the mistake most people make. They assume the cheap price is available in size. But if the cheap price is paper and physical delivery is slow and export pathways are tightening, then the cheap price is a billboard, not a store. Now, we need to keep our eye on one specific pressure point: confidence. Paper markets function as long as participants believe the paper can become metal when it matters. You don't need every contract to stand for delivery. You just need the crowd to believe they could if they wanted. Once that belief erodes, the paper becomes what it always was, a casino chip. And casinos collapse when too many people cash out at once. So the question becomes, what makes people stop playing? It's not a tweet. It's not a Reddit post. It's a persistent reality gap. If the world keeps paying $83 while the paper prints $70, sophisticated players start asking, why am I holding the discount version of the same asset? And when enough of them ask that at the same time, the system has to respond. Either the paper price rises, or the paper market tightens rules, raises margins, changes delivery terms, and tries to preserve itself by shrinking. Either way, something gives. Now, let's dig into the vault story without getting hypnotized. Registered at 127. 62 million ounces looks comforting. But comfort is not the goal. The goal is to understand the maneuver. If a bank can slide metal from eligible into registered, it can defend delivery days. It can survive the headline. But it can also be burning future options. Because eligible isn't infinite, and eligible belongs to people with choices. If you own eligible bars, and you see Shanghai paying up, and you see policies tightening, and you see backwardation flashing, you might decide you don't want your metal wearing a deliverable tag anymore. You might want it out. That is the moment the shell game ends. Not because registered hits zero, because the willingness to keep metal in the system evaporates. And that's why the spread matters more than the inventory headline. The spread is the market's lie detector. Now let's confront the part that sounds crazy until it happens. If China tightens exports and keeps absorbing metal, Western industrial buyers get trapped. They look around and realize they can't casually source from the world's biggest manufacturing hub the way they used to. They turn back to the remaining pools of liquid metal. They turn to the same vaults everyone else is watching. And that's when the big number stops looking big. Because global demand isn't a polite line on a chart. It's a machine. And machines don't pause because a futures contract printed a lower price. So when the West can't lean on the East for supply, delivery pressure concentrates. It piles up. It becomes a crowd at a single exit door. And every crowd at a single exit door eventually pushes. Here's the uncomfortable thought experiment. Imagine you are a manufacturer in Europe, building power electronics, solar components, or high-end connectors. You have purchase agreements, you have delivery schedules, you have penalties if you miss. Do you risk being the guy who can't source silver because you trusted a $70 paper quote? Or do you pay up, lock supply, and move on? That decision isn't ideological. It's operational. And operational buyers move quietly until they don't. Now, there's a detail in this story that most people won't notice until it bites them. When the spread stays wide, it invites metal to flow one way, New York to Shanghai. And if export pathways into China remain open while export pathways out tighten, that flow becomes sticky. Every ounce that chases the premium may not come back. That is a one-way door. And one-way doors are how liquidity disappears without a dramatic default headline. It's how a market gets drained without the scoreboard changing fast enough for the crowd to react. So we need to stop asking the old question, when does COMEX run out? That question is too simple. The more dangerous question is, when does COMEX become the last liquid pool? And how fast does everyone rush it? Because that is how price gaps stop being trivia and start being survival signals. Now watch the curve again. Backwardation is not a meme, it's a symptom. It says someone is paying to pull metal forward in time. It says urgency is rising. It says there's a premium on immediacy. And that matters because the paper price can be manipulated day to day, but the time structure is harder to fake for long. You can slam a chart with leverage, you can push a headline, but you can't easily force real buyers to prefer later when their line needs now. So the curve is where we watch the truth leak through, and we also watch the basis, how futures relate to physical premiums, because that's where the market admits what it can't say out loud. If physical premiums in Asia keep stretching while paper tries to stay low, the spring compresses. And compressed springs don't stay compressed forever. Now, let's talk about what we do with this information without turning it into gambling. This is educational. We manage risk. We separate fact from the story we tell ourselves. Fact: the East-West price gap printed near $12. 93. Fact: Shanghai implied pricing was around $83, 51 per ounce on those late December sessions. Fact: New York paper pricing sat in the low 70s. Fact: registered inventory reported around 127, 62 million ounces. Fact: the front of the curve showed inversion signals consistent with tightness. Fact: export restrictions and licensing talk intensify right into the January 1st threshold. Everything else is our interpretation. And our interpretation is simple. The market's plumbing is under stress, and the stress is showing up first in the spread, not the headline inventory. So what do we watch next? We watch whether the premium holds after the calendar flip. We watch whether the spread narrows because New York rises or because Shanghai falls. We watch whether the curve normalizes or stays inverted. We watch whether eligible begins to slide because that's where real owners vote with their feet. And we watch whether industrial players start behaving like the metal is scarce, regardless of what paper says. Here's a question that forces honesty. If you had to source silver for a factory that cannot stop, would you trust the cheaper price or the price attached to immediate delivery? Drop your answer in the comments, because your reasoning reveals how you see this market. And here's another one. What breaks first in your mind? The paper price rising to meet the physical premium, or the paper market changing the rules to defend itself? Tell us what you think happens and why. Because the why is where the edge lives. Now, before we get swept up in drama, remember the tactic institutions use when they feel pressure. They manufacture calm. They point to an inventory number. They point to a report. They point to a stable-looking chart. They want you to think the problem is solved because the dashboard says green. But dashboards are curated. Spreads are earned. Curves are earned. Premiums are earned. So we keep our eyes on the metrics that can't be polished as easily. And we remember the market can look liquid right up until the moment it doesn't. Now, if you're wondering why the rest of the financial world isn't screaming about an 18% regional premium, it's because most of them are trained to see commodities through a futures lens. They see paper as the real market. They see physical as a sideshow. That worldview works until physical refuses to cooperate. And when physical refuses, futures become a narrative machine, not a price discovery machine. This is how dislocations become resets. It doesn't happen with a bell ringing. It happens with repeated mismatches that make the smartest participants quietly change posture. And then one day, the adjustment is violent. So we treat this as a warning shot, not a victory lap. We don't need to scream default tomorrow. We don't need to pretend we know the exact date. We just need to recognize the sign. The world is pricing silver in two different ways. And the bridge between those prices is getting narrower, slower, and more regulated. That is not normal. That is not healthy. That is the kind of environment where the public gets the headline late, after the professionals already acted. Now here's the final cliffhanger. If the East is paying up and exports tighten, and the West is left leaning on a single paper-centered hub for liquidity, what happens the first time a big player decides they don't want paper settlement? They want bars? Not a small delivery, a real delivery, size. Because the system can survive a trickle, but it can't survive a stampede. and we are watching the early conditions that turn a trickle into a stampede, a widening premium, a hardening border, and a curve that says now. If you want to stay ahead of the crowd, don't chase the chart. Track the gap, track the curve, track the flow. And if you want more breakdowns like this, fast, clear, and grounded in the signals that matter, hit subscribe. We'll stay sharp together because the next move in this market won't be polite.